There are five specific government forms that the average American senior born before 1971 has never once filed throughout their entire lifetime. And every single one of them could return thousands of dollars directly back into their pocket before June 30th. These forms are sitting right now on the IRS and SSA websites, completely free, accessible to every qualifying senior. And almost nobody is using them, because almost nobody has ever been told they exist. Before we go any further, I need to address the single biggest misconception that causes most seniors to stop watching and walk away, leaving thousands of dollars completely unclaimed. Some people assume this topic only applies to seniors who are financially struggling. Others believe it is an advanced strategy reserved exclusively for wealthy retirees with complex portfolios. Both assumptions are completely wrong. This information applies to every senior born before 1971, whether your entire income is a Social Security check or you have a pension, savings, and a home that has tripled in value. There is real money sitting inside these five forms with your name on it. The reason nobody tells you about these is straightforward. The IRS does not advertise tax savings. Your CPA does not earn additional fees for filing forms you could complete yourself. And the deadline genuinely matters. For several of these forms, missing June 30th means waiting a full additional year to recover money that is already legally yours. This video is for educational purposes only and does not constitute tax or legal advice. Always consult a licensed CPA or enrolled agent for your specific situation before taking any action. Now, stay through the very end, because form number 5 is the most powerful on this entire list, the least known, and carries the highest monthly dollar impact for qualifying seniors. Form number 1, Form W4, P controls federal tax. Withheld from your pension or IRA, available free at irs.gov. This is the single most ignored form in the entire IRS catalog, and it is the one that puts the most cash back into your monthly income the fastest. Here is the core problem. When pension programs and IRA custodians establish your distributions, they either withhold at a default rate that is almost always set too high, or they use a broad generic calculation that assumes you have more taxable income than you actually do. The result? Every month, they hold back more than you genuinely owe. Then in April, you receive a refund, and you feel satisfied. But that feeling is costing you real money. That money belonged to you the entire year. You effectively handed the government an interest-free 12-month loan. Consider this example. Harold is 66 years old, single, living in Georgia. He receives a $38,000 annual pension. His custodian automatically withholds 10% iron, that is $3,800 held back annually. But because Harold is 65 or older and qualifies for the additional senior standard deduction, his actual federal tax liability is closer to $1,400, not $3,800. That is $2,400 per year he is lending to the government for free. That is $200 every month that should be sitting in his bank account. Form W4P is how he fixes it. He downloads it from irs.gov, completes the withholding worksheet, and submits it to his pension administrator, or IRA custodian. His withholding adjusts the very next month, not next year, the next month. Quick comment question. Are you currently having federal tax withheld from your pension or IRA distributions? Drop a yes or no below. It helps me plan the follow-up content you actually need. Form number 2, Form W4. V-Adjust Federal Tax. Withheld from your Social Security benefits, available free at ssa.gov. This form determines whether the government holds your money for an entire year and returns it as a refund, or whether the correct amount gets deposited into your account every single month. Here's something most seniors genuinely do not know. Social Security payments arrive with zero federal tax withheld by default. Not 5%, not 10%. Zero. For some seniors, that is perfectly fine. But for millions of seniors born before 1971, whose Social Security is partially taxable, that zero withholding creates a painful shock every April. They owe far more than anticipated. In some cases, they face an underpayment penalty on top of the tax bill, all because they were never informed that Form W-4V existed. Form W-4V allows you to select your Social Security withholding rate. You have exactly four options: 7%, 10%, 12%, or 22%. You choose the rate that most accurately aligns with what you actually owe, and this matters in both directions. Some seniors are under-withheld and face a surprise bill every April, but others are significantly over-withheld. They selected 22% years ago when their income was higher, and now they are overpaying by hundreds of dollars monthly. Consider Dorothy. She is 70, married, and both she and her husband collect Social Security. Their combined benefit is $34,000 annually. Her husband set up 22% withholding years ago. Now, with their current deductions, their actual effective rate on that Social Security income is closer to 9%. They are overpaying by approximately $2,200 annually, more than $180 every single month that should be paying for groceries, prescriptions, and utilities. A new Form W-4V submitted to the Social Security Administration corrects it immediately. You can submit it online through your My Social Security account at ssa.gov, by mail, or in person at your local SSA office. Form number 3, Form 104-0-SR, the tax return specifically designed for seniors 65 and older, available at irs.gov and all major tax software platforms. The IRS created Form 1040-SR exclusively for taxpayers age 65 and older. And millions of seniors still file the standard 1040 every single year, completely unaware that a version designed specifically for their situation exists. The 1040-SR features larger print throughout, which matters for practical reasons. But the truly important distinction is what is structurally built into the form itself. The 1040-SR includes a dedicated section for calculating the additional standard deduction for seniors 65 and older. It features a cleaner, more intuitive layout for reporting Social Security income and pension distributions, the two most common income sources for people in your age group. And it contains built-in sections for the senior bonus deduction that many tax preparers and software programs simply fail to flag automatically on the standard 1040. You can technically claim everything on the regular form, but the 1040-SR places the deductions and income categories most relevant to your situation directly in front of you, not buried inside schedules and worksheets that a standard working age filer would never navigate. Here is your specific action step. If you use a CPA or tax preparer, ask them one direct question before signing your return. Are you filing my return on Form 1040-SR? If the answer is no, ask clearly why not. If they cannot provide a specific reason, that conversation deserves a follow-up. If you file independently using tax software, look for the option to switch to Form 1040-SR before submitting. Most major platforms support it. It may appear listed as Senior Return, or confirming your age in the profile section will automatically route you to the correct version. Form number 4. Form 8606 protects you from being taxed twice on the same dollar. Filed as part of your annual tax return. This is the form that prevents double taxation on IRA contributions, and it is the one that retirees are quietly losing tens of thousands of dollars over. Not because of anything dishonest or complicated, but simply because nobody tracked a number that should have been recorded years ago. Here is the situation. When most people contribute to a traditional IRA, those contributions are tax deductible. You contribute, it reduces your taxable income for that year, and you pay taxes when you withdraw later. Straightforward. But some people, particularly those whose income in certain years exceeded the deductibility limits, made what are called non-deductible IRA contributions. They deposited after-tax money into the IRA, money they had already paid income taxes on. If nobody properly tracks that after-tax amount, formally called your IRA basis, then when you begin taking distributions in retirement, the IRS treats every single dollar as pre-tax money and taxes it again. You have paid income tax on the same dollar twice. Consider Robert. Over his working career, he made $45,000 in non-deductible IRA contributions. He never filed Form 8606 consistently, and neither did his accountant. Now at 68, taking required minimum distributions, the IRS has no documented basis on file. His custodian reports the entire distribution as fully taxable. He is being taxed on $45,000 he already paid taxes on at a 22% federal rate. That equals $9,900 in taxes he should never have owed. Form 8606 is how you document your IRA basis. You file it with your annual return for any year you make a non-deductible contribution. And critically, if you have made past non-deductible contributions without filing. Form 8606, you can submit amended returns to establish your basis going back to those original years. This form is also essential for anyone who has completed or plans to complete a backdoor Roth conversion. Without Form 8606 on file, the IRS sees no record that the original contribution was non-deductible, and the conversion appears fully taxable when it legally should not be. If you have contributed to a traditional IRA at any point and are not completely certain whether all contributions were deductible, raise this with your CPA before June 30th. Form number 5, Form SSA-44, the IRMAA Life-Changing Event Appeal, the most powerful form on this list available free at ssa.gov. I promised you at the beginning that Form number 5 carries the highest dollar impact for qualifying seniors. This is it. And most seniors have never once heard of it. To understand why it matters, you first need to understand IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, an additional charge layered on top of your standard Medicare Part B premium, applied to beneficiaries whose annual income exceeds certain defined thresholds. Based on information from the Centers for Medicare and Medicaid Services at cms.gov, the standard Part B premium in 2026 is $185 per month. But if your income from 2 years ago, specifically your 2024 tax return, exceeded certain levels, Medicare is charging you significantly more right now. For single filers, IRMAA surcharges begin when modified adjusted gross income exceeds $106,000. The first surcharge tier adds $74 per month. As income rises through higher tiers, that additional charge climbs up to $443 per month per individual. For married couples filing jointly, thresholds are double, and surcharges apply to both spouses separately. Here is the trap that catches retirees specifically. Medicare does not look at your current income. It looks at your income from 2 years ago. So, if you retired in 2024 and your income that year was elevated, because you worked through the first half of the year, sold a business, took a large IRA distribution, or received a pension lump sum, Medicare used that elevated 2024 income to set your 2026 premiums. Even though your income dropped dramatically when you retired, even though you are now living on Social Security and a modest pension, representing a fraction of what you earned in 2024, you are still paying a surcharge based on income you no longer have and will never have again. That is not fair, and there is a direct correction mechanism built into the system. Form SSA-44 is a life-changing event appeal. It formally notifies the Social Security Administration to use your current actual income when calculating your premium, rather than the outdated 2-year-old figure that no longer reflects your reality. There are 8 qualifying life-changing events. 1. Marriage. 2. Divorce or annulment. 3. Death of a spouse. 4. Work stoppage, retirement, most relevant for the majority of retirees. 5. Reduction in work hours or income. 6. Loss of income-producing property. 7. Loss of pension income. 8. Receipt of an employer settlement payment that temporarily inflated prior year income. The real Arizona scenario. I promised you. Frank and Carol are both 67 years old. Frank retired from his engineering position in June 2024. Carol retired from her school district role in July 2024. Their combined modified adjusted gross income for 2024 came in at $260,000 due to the months they worked before retiring. Medicare used that elevated figure to set their 2026 premiums. Frank landed in the second IRMAA tier, an extra $259.20 per month. Carol landed in the first tier I, an extra $74 per month. Together, they were paying over $330 monthly in combined surcharges on top of standard premiums. Their actual 2026 income? $52,000 combined, Social Security for both, plus a small pension from Carol's district. They were paying premium surcharges based on income they had not received in nearly 2 years and would never receive again. Frank filed Form SSA 44. Carol filed Form SSA 44. Both documented their current projected income clearly. The Social Security Administration reviewed both appeals. Both premiums dropped back to the standard rate. Combined monthly savings over $330 per month. Annualized savings over $3,960. Total savings for the year, including recovered prior months, exceeded $5,000. One form each. Free at ssa.gov. Approximately 20 minutes to complete. You can submit Form SSA-44 online through your My Social Security account, by mail, or in person at your local Social Security office. You can also call the SSA directly at 1-800-772-1213 to request the form by phone. Once approved, corrections typically take effect within 1 to 2 billing cycles, your priority action plan, before June 30th. Here is the exact sequence to follow. Priority 1. Form S, SA-44, ssa.gov. If you are currently paying an IRMAA surcharge and have retired or experienced any qualifying life event, file this immediately. Highest dollar impact. Fastest correction. Priority 2. Form W-4. PIRS.gov. If you receive pension or IRA distributions and suspect withholding is higher than what you actually owe, this is your next step. Priority 3. Form W-4V, SSA.gov. If your Social Security is partially taxable and your withholding situation does not clearly match your current income level, address this third. Priority 4. Form 104, O-SR, irs.gov/tax software. Confirm with your preparer they are using this form. If filing independently, verify your software routes you to the senior version. Priority 5K, Form 8606, filed with annual return. If you have any history of non-deductible IRA contributions, raise this with your CPA immediately. The most important thing I can leave you with, in every single one of these cases, the form already exists. The IRS and Social Security Administration already accept it. Your savings are already legally yours. Form W-4P is on irs.gov right now. Form W-4V is at ssa.gov. Form 104 O-SR is in every major tax software platform. Form 8606 is legally required for anyone with IRA basis. Form SSA-44 has been available since the IRMAA system was established. Every single one is real, not one is automatic. The government does not refund you for the form you forgot to file. No one mails you a check for the appeal you never submitted. The system is structured so the money stays exactly where it is, unless you personally stand up and claim it. These 5 forms are how you claim what is already yours. Tax laws change frequently. This content reflects the 2026 tax year based on currently verified sources. Always consult a licensed CPA enrolled agent or qualified tax professional before taking action on your specific situation. If even one of these 5 forms was new to you today, hit the like button. Share this with one person born before 1971 who needs to see it before June 30th. Drop a comment and tell me which form you had never heard of before today. You worked for decades, you saved, you sacrificed, and sitting on irs.gov and ssa.gov right now are forms designed specifically for people like you. The IRS is not going to call and tell you what you are owed. Nobody is. That responsibility is yours, and now you know exactly where to look.